The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
You're listening to The Ascent with Crestmont Private Wealth. This is Alec Walker and Rebecca Pitre coming to you live from our Houston office, broadcasting into Boerne and the Hill Country. Rebecca, this is your second maiden voyage on the Crestmont The Ascent podcast. Is that correct?
Yep, this is my second time on the podcast.
Yes, I think your first episode was literally your first day with the company, and Sam got you in the office. Boerne from Boerne Radio was in there with this equipment, and so y'all recorded an episode. So this is almost 7 months later. You've been with the team for quite a while now. Rebecca's a paraplanner on our financial planning team with Sam and myself. So she's going to be joining us today, asking me some questions that clients have been emailing over the holidays and early in the year, changes related, really focused on a tax perspective. But before we get there, Rebecca, I just wanted to kind of back up a little bit. The last episode that I'd recorded was year-end financial planning without the year-end stress, and the focus was really on gathering that information, taking a look at your expenses, and really just kind of focusing on your goals for 2026. So hopefully folks were able to do that, and that'll set us up for some productive meetings this year. But where we are right now, we're going to be sending out a newsletter to our clients next week, talking about some tax changes, and it's tax time. W-2s are coming in, tax forms are going to be released from Schwab and different broker dealers. So what we're just telling clients right now is be patient. Some of those tax forms are going to come quicker than others. Once you gather all that information, get it to your CPA, and then we can help you as well with any tax planning situations. But Rebecca, why don't you kind of get us started on some of these questions?
Sure.
What's the first one that we've been hearing from clients?
So going into the 2026 year, what should people know about the IRA contribution limits, and how might this change for their retirement planning?
Yep. So obviously, as we flip over to the calendar year, generally most of our tax tables and IRA contributions, there's going to be some adjustment to those. So for the 2026 tax year, for traditional and Roth IRAs, those contribution limits have increased to $7,500. And then, of course, for the catch-up contribution for those that are age 50 and older, the catch-up contribution is $1,100. So it's actually kind of nuanced. I had to double take as well. Usually we have a nice round number. It's either, it's 8,500 or it's 8,000. This year, you kind of have to look again. So the max is 8,600 for those 50 and older. So make sure you're not missing out on that last $100 contribution. And then as it relates to Roth IRAs, so for most folks, most people nowadays, if you're covered by a 401k plan through your employer, contributing to a traditional IRA, most of the time you're phased out from being able to deduct that contribution against your taxes. It does depend on what your income is. So many times if you're contributing to a 401k, a Roth IRA makes sense, but also be aware that those Roth IRAs also have income limits as well. So if you're single and your income is below $153,000, your adjusted gross income, you can make that full contribution. If you're married filing jointly and your combined household income is less than $242,000, you and your spouse could make that full Roth IRA contribution. So be aware of that. On that point, you may be like, well, I don't know what my full income is going to be. I haven't completed my taxes. For those 2025 contributions, which those limits are a little bit less, $7,000 for the traditional and Roth IRA contribution, you have until you file your taxes, so up until April 15th, to make those Roth or traditional IRA contributions for the 2025 tax year. And then finally, just real quick, within the 401k, those limits have also increased for this year. So the regular employee contribution is $24,500 per year, and the catch-up limit for those 50 and older is $8,000. Also remember, this was from the Secure Act 2.0. There is an additional special catch-up contribution for those age 60 to 63. You can contribute an additional $11,250 on top of that catch-up contribution. So those are kind of some of the major changes on the IRA side of things.
Yeah, so maybe changing it up, how can you explain why high earners are now being pushed into making Roth only catch-up contributions and what that really means for their future tax planning?
Yeah, this has been surprisingly one of the biggest questions that we've got from around Christmas to now is I think what's happening is these 401k plans are sending out notices to clients on this new rule. So what this was from the Secure Act 2.0 again is for high earners, and those high earners are defined as wages exceeding $150,000. For those that are 50 and older, any catch-up contributions that you're making must be made with Roth or after-tax dollars. So previously, you could make that 24,500 contribution pre-tax. You could make that $8,000 contribution as well pre-tax. And for a lot of those high earners, who are in higher income tax brackets, that makes a ton of sense because while you're working, probably nearing retirement in your higher earning years, you generally want to put as much money away before tax so that when you retire and you're likely in a lower tax bracket, you can then pull that money out at a lower tax rate. That's not the case anymore. Unfortunately, there's not really any workaround. This is a law change. Essentially, this is a way for the government to say, hey, we want a little bit more tax revenue now. Because if you think about it, it's possible that a lot of these people putting this money away pre-tax, that additional $8,000, they might not be touching that money for the next 10, 15, 20 years, maybe ever for that revenue now. What we're recommending for clients is really not to make a change. If you're able to make those additional catch-up contributions, that's part of your budget, that's part of your retirement savings, continue doing it. Even though it's going in Roth, it's going in after tax, really that's just going to affect your take-home pay a little bit while you're working. You're going to have a little bit more taken out of taxes. But on the flip side, now you're building up a little bit of Roth assets as well within your plan. It could end up being slightly suboptimal, but you're also diversifying your sources of tax assets.
Yeah, so now pivoting towards charitable donations and contributions, with the new rule requiring charitable donations to exceed 0.5% of your adjusted gross income before they become deductible, how should taxpayers think about tracking or planning larger gifts to make sure their contributions actually provide a tax benefit?
Great question. This, again, another tax law change. This was from the One Big Beautiful Bill that passed last year, not the Secure Act 2.0. And you're correct. So essentially what this is saying is that if you're somebody that itemizes their deductions, you make charitable contributions, you have mortgage interest, you pay property taxes, those generally add up to be more than the standard deduction. What they're now saying is those charitable deductions, you have to exceed 0.5% of your adjusted gross income to be able to deduct that charitable deduction. So hypothetically, if your income is $250,000, 0.5% of that is $1,250. If you're donating $10,000 to charity, that first $1,250 of that 10 is not going to be deductible. You're only going to get to deduct the amount above that first $1,250. So very similar to the Roth catch-up rule change. This is just a way for the government to get a little bit more tax revenue. What we're recommending for clients is continue with your charitable giving as is. It's just going to be less tax beneficial for you. What we do want to do, to your point, Rebecca, on making sure you're doing it correctly and calculating things correctly, is we use a tool called Holistiplan where we can compare a client's 2024 tax return or 2025 return, project what it's going to look like in 2026, and we can put in those actual charitable numbers to make sure we're getting kind of the right projections and the right forecasts.
So since charitable donations only reduce taxes when you itemize, what strategy should people consider to exceed that standard deduction?
Great point. So there was, and I actually think a pretty beneficial change for those folks that do take the standard deduction. Maybe, you don't have a mortgage, you've paid off your house, your property taxes and state and local taxes aren't significantly high. And that standard deduction for a married couple, it's $32,200. You're comfortable taking that. Previously, any charitable contributions you're making, let's say you give $2,000 here, $5,000 here, you're obviously donating that money and the charity's benefiting from it, but you're not receiving a tax benefit. The new change this year is that you can actually give cash donations as a standard deduction filer and claim that, quote unquote, that itemized charitable deduction in addition to your standard deduction. So for those married filing jointly, it's $2,000. For single filers, it's $1,000. The one caveat there is that those must be cash donations directly to charitable organizations. If you have a donor advised fund, you can't contribute cash or highly appreciated stock to a donor advised fund. These must be cash donations directly to those organizations. But a married couple can now make that $32,200 standard deduction plus the additional $2,000 charitable deduction on top of that.
So now regarding the SALT deduction, how do you anticipate the expanded SALT deduction will impact tax planning for individuals, particularly those in high tax states? And what is that new deduction cap?
So this did go into effect for 2025, but it's so impactful and it is a change from prior years that I just wanted to reemphasize it. The SALT deduction has been increased. It was $10,000 from 2017 when the Tax Cuts and Job Acts law, they reduced that. It's now back up to $40,000 and it's $40,400 for 2026. So we work with a lot of clients that are out of state in state income tax states, Oregon, Colorado, Arkansas, Oklahoma. So this is a big change for those folks to be able to itemize those state and local property taxes, particularly if they're also folks that were charitably inclined. It can lead to increased tax savings for them. So this is something that we are really focused on looking at for 2026.
So are there any other not so common or easily overlooked tax changes this year that people should be aware of?
Yes, there are a few changes related to 529 plans. So previously for 529s, you could withdraw $10,000 per year for K through 12 private education. Those limits have now doubled. In 2026, you can distribute up to $20,000 for those 529 plans for K through 12 private tuition. And the uses for those expenses have also expanded a little bit as well. So we can provide some insight on that. A couple other two kind of minor changes that went into effect in 2025 from the One Big Beautiful Bill. There is a senior deduction, additional enhanced senior deduction for 2025 through 2028. Those 65 and older can deduct an additional $6,000 per person. Now, this does start to phase out at $150,000 for married couples. But if your income is below that because of, maybe Social Security income or some tax-free income that you've got coming in, this is kind of an enhanced deduction on top of the standard deduction. And then I'd say one that's pretty interesting as well. We've been getting a lot of questions from clients, new car season, especially at the end of the year. Auto loan interest can be deducted, up to $10,000 can be deducted for tax years 2025 through 2028 as well. And that does, for a married couple, does start to fully phase out at $250,000. We talked about a lot of tax information today on the episode. Just as a disclaimer, Crestmont Private Wealth is not a CPA. We do not provide tax advice, though we do provide, tax planning consultation as it relates to their client's financial plan. We recommend that you consult your CPA for any tax specific advice. But Rebecca, I think those are probably the main kind of ancillary items that we're looking at. I really appreciate you jumping on your second visit on the Ascent trip up the mountain.
Yeah,
we'll have to get you back on again. I know that we're both going to be looking forward to, I know this is broadcasting out in the Boerne, San Antonio area. It could be Cowboys country there, but we're here in Houston. We're Texans fans, and we're hoping that the good guys can get a victory on Sunday against the Patriots. First ever trip to the championship round for our Texans. So y'all have a great weekend.
Bye.